Agam is here with some perspective and some data. Agam.
Right. So India's capital expenditure trends have turned a corner, and economists as well as analysts now suggest that there is evident signs of revival in capex through full-fledged return, however, is still a year away. Now, broking firm Jefferies says that the government capex has been increasing since FY21, which is encouraging, though not yet enough. And private capex uptrend is now visible in selective sectors. There are certain conditions which indicate this potential revival. And ICICI Securities report says that the cash flow from operations for listed companies has steadily risen over the years, and this has led to the ratio of cash flow from operations to capex rising to a two-decade high. Why this is significant is because the last time, which was in around the period of 2002 to 2004, marked the commencement of the previous capital expenditure cycle. Among other conditions conducive to the capex cycle are factors such as resilient commodity prices and improving capacity utilization, lower declining real interest rates, as well as better liquidity conditions and incremental allocation to capex spends from the central government. Now, metal, other materials, information technology, industries, as well as utilities lead in terms of cash flow from operations exceeding capital expenditure at the moment. Among sectors with the highest spends in plant, property and equipment in FY21, we have energy, telecom, utilities, consumer staples, real estate, and in fact, certain sectors in the private sector already have capex above the pre-pandemic levels. These include metals, electricals, data centers, and drugs and pharmaceuticals. There are, however, in the near term, some challenges. These include state government capex outlays, which continue to stay subdued across the board. And strength in private sector capex will only be gradual. Once we do see a meaningful recovery, we're surely to say that the capex cycle is at hand.
Okay, very helpful data. Thanks a lot for that, Agam. And what stayed with me is that comment in the Jefferies report where they say that private capex is visible in certain pockets. I think we're seeing private capex come through after years of a slowdown. Vinod Karki, the head of strategy research at ICICI Security, and Deepak Shetty, the chairman of CII's National Council Committee on Capital Goods and Engineering, and the MD and CEO of JCB India join us now. Vinod, let me start with you. You know, just coming back to that Jefferies report where they mentioned that, yes, government capex has picked up, but now there are some signs of green shoots in terms of private capex as well. Are you noticing that too? And if yes, can you just, elaborate on that? Where are you seeing the maximum amount of capex come through from?
Yeah, good morning, Sonia, and thanks for having me on the show. Yeah, so, as far as, so there are 2 points. One is the good news around capex, and there is some amount of challenges still. In terms of, if you may call it the bad news, we are currently still suboptimal in terms of the capacity utilization overall, just below 70% as per the RBI last report. So that is one challenge which is an issue right now. But however, having said that, capacity utilization is a function of how demand will pan out. And the demand outlook is looking quite resilient, right? And what is important to note is that capex is a capital allocation discipline. And it depends on how the cash flows are panning out and how the demand outlook is for companies. That really triggers the capex cycle. So on that front, we have seen that if you see the operating cash flow to capex number, it's at a two-decade high, right? As per our study, it was similar at 2002-03 levels. And the demand outlook, if you see global demand outlook or even India's outlook, that's picking up. And that is triggering some amount of animal spirits. And we are seeing a lot of these capital-intensive companies starting to announce capex plans. Because, so for example, when you start a steel plant, you take at least 4 or 5 years to complete it, and you are at 80%, 90%. There is no way you'll be able to, come up with that supply in a short period of time. So that is what I think will be crucial, that availability of financial resources and how the demand outlook and the policy. So in the form of the policy outlook also, we have seen the latest, if you see on a telecom reform or the bad bank or the PLI, what it's doing is it is actually improving this cash flow available for companies to invest further, apart from what these companies are already generating high cash flows.
Vinod, let me take up your central point with Mr. Deepak Shetty as well. And the central point that Vinod is making is that when cash flow becomes higher than the capital expenditure, then a company will obviously get into the cycle of perhaps investing in further capex. Mr. Shetty, thanks for joining in. Now, is that a point that you would concur with? And, is that the evidence that the past cycle also throws up? And if that's the case, which are the sectors where you are seeing perhaps, the first move when it comes to private sector capex?
First of all, good morning, and thank you for having me. I think it's a very interesting point, but I would differ a little bit in a sense that some of the investments on the capex side is also considering the future. And while cash flow plays a very, very important role because you want to spend what you have, but at the same time, looking at the forecast for next 5 years, and that also is probably motivating the companies because we are almost coming out of the second wave of pandemic. The second wave of pandemic has panned out much differently than the first wave, and I'm seeing across the sector companies looking at the opportunity in the front and going forward. If I specifically speak about a couple of sectors, for example, on the infrastructure side, the announcements which were made by the Honorable Finance Minister as a part of the budget has been further reinforced recently by the Prime Minister when he spoke about the Gati Shakti project, and we are seeing actions on the ground. And this is actually motivating companies to go forward. If I speak specifically about my company, JCB, during the first wave, we had to put some of our investments on hold. But during the second wave, we continued with our investments in our 6th plant in Vadodara and almost 1,000 crores investment. And I'm seeing the same approach being taken by other companies because as was rightly mentioned by the gentleman earlier, we are at the base of a big capex cycle and one has to be prepared looking at the opportunity in the front.
There is though one big hurdle, right? A lot of this private corporate capex rise is on hopes that there would be a rising PLI, of course the PLI spends, and there would also be a significant up move in the new technology. So whether it's electric vehicles, hydrogen, solar, and we all understand that India will take a few more years as far as spending in some of this new technology will come through, whether it's EVs, whether it's, solar, etc. Mr. Shetty, your thoughts on that? What are the challenges that still lie ahead for private sector capex to pick up?
It's a very interesting point you're making. We have seen that some of the announcements which have been made are translating into actions, but we want to see more actions on the ground, and that will probably motivate people in the private sector. Now, having said that, I also want to mention that globally, if you see all the economies around the world, every major economy is showing an improvement, and this is translating into an opportunity for exports also. And sometimes we look at domestically, obviously India is a big market, but the export opportunities are also huge. And part of this capex investment that the private sector is looking at is not only looking at what we have in India, but also globally. And if I speak about construction equipment sector, our sector has again a great opportunity on the export side. And we are now exporting to more than 110 countries around the world. So there is a balance between the two. Now, coming to the second part of your question, certainly it is very heartening to see the announcements on EV, on hydrogen, etc. And you are absolutely right that it will take maybe 5 or 10 years by the time we have the necessary infrastructure. But having said that, we can't forget that there is a huge component supplier base in India, which can support the global companies as they move forward in this particular journey. And also, while EV and hydrogen can take time, CNG is already here. We have recently launched a CNG backhoe machine, a dual tech backhoe machine. So the companies in India are also stepwise investing in this sector. And obviously, the recently government's announcement on PLI will certainly encourage more companies to invest and also look at the global markets.
Okay. Well, let's also start distilling this down to companies and stocks. And Vinod, my question is this. Now, we know after the first quarter GDP print, the surprising factor was government expenditure, which is, of course, government expenses on, public expenditure. that has actually been falling in real terms, with the government being very prudent despite its soaring tax collections. So in such a scenario, I mean, which are the best companies to play? Do you stick with some of the construction names, perhaps road companies that benefit when there is higher government expenditure, or should you look out for the companies that will benefit from the rise in private capex?
Yes, so Surabhi, if you look at it carefully, the GDP print, it is very clear that gross fixed capital formation and manufacturing, and even if you look after that, the IIP numbers, is clearly pointing that the investment side of the economy is doing better than the consumption side. So if you look at the private final consumption expenditure, or in the IIP, the consumer segment, that's actually seeing a slowdown as compared to the investment side of the economy. Now, while the government overall spending might be looking weak, but if you look at the capex, especially in FY22 now, both at the state and center level, that's actually quite resilient, especially the center. States are still a little behind, although they are still better than 2019-20 levels. So I think while the revenue side of the expenditure might have been a little weak, I think the capex spent by the government, I don't think that has slowed down. And what is even more encouraging is the tax buoyancy that we have seen in FY22. That's the best we have seen in a long time. So that makes it even better for the vendors, the guys who build infrastructure for the government, that their cash flows should see an improvement because the government has better tax points to pay them off. Their cash flows should improve, right? So I think I don't think the economic recovery, clearly, if you look at the GDP, is coming from the gross fixed capital formation, manufacturing, and net exports, while the private final consumption expenditures where the slack is basically.
Okay, at the end of the day, we know that boils down to, for our viewers at least, what stocks to buy, what stocks to sell, to play this sort of theme, right? I mean, and I guess the simplistic way to play the recovery in the capex cycle is to buy some of these perhaps property developers, cement companies, home improvement themes. I don't know, I'm just making a guess, but you tell us, how does a retail investor play this?
So I think, if you look at it broadly, you have to be very careful about these events, because 2002 to 2010-11, it was a period of the gross fixed capital formation driving the GDP, and therefore most of the stocks which outperformed were from these sectors basically. And from there, the gross fixed capital formation started going down, and private final consumption expenditure picked up, and you had the whole consumption basket running. So actually, the stock market only reflects where the demand is being generated in the economy. And we are seeing initial signs that this recovery is being driven by the investment side of the economy. So balance sheet driven companies, I think that is where we think could see outperformance, especially because they are at reasonable valuations. They are not as expensive as it is on the quality and the consumption side of the economy. So stocks like, the Larsen & Toubro, Ultratech, Hindalco, Bharti, NTPC, ONGC, some of these stocks, which are balance sheet driven, are amongst our top picks, where the valuations are not too demanding. And they have shown signs of performance over the recent past. So the market is also kind of acknowledging that the demand could be better in this space, the investment side of the economy, and that the valuations are reasonable there. So that's how one should look at the investment side of the economy, basically.
Okay, all right, gentlemen, we'll wrap it up on that note. Thanks very much for the perspective in the capex cycle, and of course how perhaps the investors can play it. Speaking of investors, right now, Anuj, I guess you'd say, given the kind of shakeout in Asia, not a bad place to be in?
Not a bad place to be in. The first dip normally